Good day, ladies and gentlemen. Welcome to my YouTube channel. Today, we're going to be looking at gross income as well as special inclusions. So let's take a look at the learning outcomes briefly. So at the end of the session, we need to be able to recognize gross income and apply the requirements of the gross income definition to practical situations. We need to be able to recognize and apply the relevant case law principles to practical situations. And we need to be able to discuss and apply the principles in professionally and well-structured written arguments based on the given practical situations or questions. And lastly, we need to be able to discuss and apply the legal and general principles included in the statutory inclusions in the gross income definition to practical case studies. So let's get right into it. Let's take a look at the income tax framework quickly. We've got gross income as defined in Section 1 of the Income Tax Act, less exemptions which are provided for in Section 10 of the Income Tax Act. So your gross income less your exemptions will give you income. Income less deductions and allowances, you get taxable income before capital gains inclusions. So we will add the capital gains, the taxable capital gains, if any, in terms of the 8th schedule of the Income Tax Act. Then we will have taxable income. And at this point, depending on the nature of the taxpayer, we will either use the tax tables if the taxpayer is a natural person or a small business corporation. But if we're dealing with a company, at this point, we will just multiply the taxable income by 28%. So I just wanted to show you where we are in the framework. This is where we are. We are at the very first item in the income tax framework, and that is gross income. So in the next session, we're going to get into exemptions and Introduction. Section 1 of the Income Tax Act defines gross income in relation to any year or period of assessment as a total amount in cash or otherwise received by or accrued to in favor of during the year or period of assessment, not of a capital nature. In the case of a resident, this total amount received by or accrued to in favor of the resident must be from worldwide receipts and accruals. And in the case of a non-resident, this gross income must be from a source within the Republic. So that's the difference between the resident and the non-resident. The resident is taxed on worldwide income, worldwide receipts and accruals, and the non-resident is only taxed on income received from a South African source. All right. So I just want to share with you guys a few tax cases in relation to the gross income definition. And the reason I'm making reference to the case laws is because the Income Tax Act gets a bit vague and ambiguous. I mean, what does it mean when it says there must be a total amount in cash or otherwise? What does the income tax mean when it says this total amount must be received by or accrued to? So it gets a bit ambiguous, it gets a bit vague. So therefore, we make reference to the case laws. These tax cases play a very huge role, and you will be tested on the principles from these cases. All right. So I'm just going to share a few tax cases with you guys. So for the first element of the gross income definition, which is the total amount received by or accrued to in cash or otherwise, there's Seesaws versus Brumeria Renaissance Pty Ltd. So that's the name of the tax case, right? So I'm just going to share with you guys the facts, the issue of the case, and the decision of the case. So the facts are the taxpayer, a developer, constructed residential units in a retirement village. The investors granted interest-free loans to the taxpayer in consideration for the acquisition of the life interest in the units. So this taxpayer is a developer. He has constructed residential units in a retirement village. And instead of being paid cash for these residential units, he received an interest-free loan as consideration in exchange for the residential units. So that's what happened in this case. So the court had to decide whether the receipt of an interest-free loan constituted a taxable benefit other than cash. Basically, the court had to decide, does this interest-free loan constitute income to this taxpayer? And therefore, it was held. And when I say held, I mean, this is what the court decided. It was held that the benefit obtained by the taxpayer had an ascertainable monetary value. The amount of this benefit, valued against the background of a market-related interest rate, was fully taxable. So the principle from this case is that a taxpayer does not necessarily have to receive cash for them to be taxed. But if the taxpayer receives an asset or an interest-free loan or whatever it is, this, as long as this item that the taxpayer has received has an ascertainable monetary value, as long as it's good value, the value will be included as gross income. So that's the principle from this case, right? I just want to move on to the next case. And the second case is CIR, and CIR stands for Commissioner for Inland Revenue. So it's CIR versus Late Gun, and this was in 1926. This is a very old case, but it's still very relevant today. So what happened in this case was the taxpayer, a wine farmer, entered into an agreement to dispose of the wine he had made during the year of assessment. A portion of the selling price was paid prior to the end of his year of assessment, and the balance was to be paid in installments after the end of the year of assessment. So we have a wine farmer who entered into an agreement to dispose of his wine, and a portion was received in the current year of assessment, and the balance was to be paid in installments after the year of assessment. So the court had to establish the total amount that had accrued to the taxpayer during the relevant year of assessment. Is the total amount the amount that was received in the current year, or is the total amount the amount including the installments that he is yet to receive? So it was held that the term accrued to means to become entitled to. Therefore, the installments payable after the year of assessment in respect of the wine produced during the year of assessment formed part of the gross income of the taxpayer for that year, meaning that the taxpayer was entitled to receive the money. So if the taxpayer is entitled to receive money, it doesn't matter that they haven't received it yet. As long as the taxpayer is accrued to, as long as the taxpayer is entitled to this amount of money, then the full amount is included in the current year of assessment. So that's the principle. Let's go through the principle. Principle number one, the term amount does not include money only, but also the value of every form of property, corporeal or incorporeal, earned by the taxpayer will be included in gross income. So the term amount does not include money only, but every form of property earned by the taxpayer will be included in gross income. Number two, When the taxpayer is entitled to an amount, it has accrued to him and therefore it should be taxable. So I just wanted to take you guys through the cases because you guys will be tested on the principles of these tax cases. All right. The next part is the total amount in cash or otherwise must be in favor of this taxpayer. And I just want to share with you guys this case, CIR, Commissioner for Inland Revenue versus Vettorsrand Association of Racing Clubs. This was in 1960, but this case is still very relevant today. Let's take a look at the facts. The taxpayer hosted a race meeting with the intention of dividing the proceeds between two non-profit charities. The commissioner included the proceeds in the gross income of the taxpayer, even though the proceeds were divided between the two charities after the event. So we have a taxpayer who hosted a race meeting with the intention of taking the proceeds and dividing them between two non-profit charities. Let's take a look at the issue. The court had to establish whether the proceeds paid over to the charities were taxable in the hands of the racing association. Were the proceeds taxable in the hands of the racing association, despite the fact that the intention was not to keep the proceeds, but to divide the proceeds between two non-profit charities. So it was held that the taxpayer had embarked on a scheme of profit making and was liable for tax upon the proceeds, regardless of the fact that they were distributed to charities. So this is the decision that the court came to, and the court decided that the taxpayer had embarked on a scheme of profit making and was liable for tax upon the proceeds, regardless of the fact that the intention was not to keep the proceeds to himself or to itself, since it was a company, it was an association of racing clubs. The principle, therefore, is when an amount has been received by or accrued to a taxpayer, it is taxed in his hand, even though he may have an obligation to pay it over to some other person. So if a taxpayer has received an amount or has is accrued to receive an amount, this amount will be taxed in the taxpayer's hand, even though the taxpayer may have an obligation to pay the money over to some other person. The association acted as a principal and not as an agent when receiving the proceeds from the race meeting. Had the taxpayer ceded his full right to those proceeds to the charities prior to receiving them, he would have been regarded as an agent, and the proceeds thereof would have not been included in the gross income of this racing association. So that's the principle from this case. If a taxpayer is receiving money on behalf of another person or another institution, this taxpayer is supposed to cede the right to receive those proceeds prior to receiving them. So in a nutshell, what I'm trying to say is, had the proceeds from the racing, had the proceeds from the race meeting went straight to the charities, then this taxpayer would have not been taxed on the proceeds. But unfortunately, the proceeds were received by the racing association before being divided between the two charities. So that's the principle from this case. And I can't, like I keep saying this, you guys will be tested on these principles. Then there's deposits and receipts in advance. what is the tax treatment of a deposit, or what is the tax treatment of receipts in advance. The Income Tax Act does not really cover this, and that's why we make reference to these tax cases. So for the deposits and receipts in advance, there's the Payout Limited versus CIR. CIR stands for Commissioner for Inland Revenue. This was in 1945, and it's still a very relevant case today. So let's take a look at the facts, the issue, the decision, as well as the principle. In this case, a biscuit manufacturer sold tinned biscuits. The customers could return the tins and receive money for the tin. The company treated the proceeds relating to the tin as a deposit and not gross income, and the commissioner disallowed this. So there's a biscuit manufacturer who's selling tinned biscuits, and the idea is when customers return the tins, they receive money for the tins. So this company treated the proceeds relating to the tins as a deposit and not gross income, and this was disallowed. So the issue was, is the provision for future tin returns allowed to be deducted? Is the full value received for the sale of tins with the biscuit income as defined? So basically the issue was, how do we treat these deposits for tins, considering the fact that some of the money for the tins is going to be paid back to the customers who return the tins. So how do you then go about it? So the commissioner held that the provision for future claims represented a contingent liability and is therefore not allowed to be deducted. Furthermore, the amount received for the tins constitutes cash and must therefore be included in gross income of the company. The amount received for the tins is not capital in nature. The principle, therefore, is generally deposits are still received and form part of gross income. An exception to this principle is where the money is kept in a separate bank account and is not used by the company for their own benefit. So I'll give a typical example of deposits and receipts in advance. If you're going on a holiday and you decide to book you book a hotel and you pay a deposit, right? So the principle from this case is that if the hotel will take that deposit and include it with their income, then they will be taxed on that deposit. And this is regardless of the fact that you may come back and cancel your stay there and want your deposit back, right? However, if this hotel takes the money, the deposit money, and puts it in a separate bank account, then they won't be taxed on that amount. So that's where the principle comes from. It comes from this case. It's still applied till today. So I'm making reference to these tax cases because you will be tested on the principles, but your lecturers don't expect you to write down the facts, the issue. That you're not expected to go in detail, but you are expected to be able to link a particular tax case to a question. You are expected to apply the principles. That's all your lecturers expect from you. They expect you to know the principle from the case. All right. It's only when you're in postgrad where you then, like if you're doing like a postgrad in tax, then you have to know the facts. You have to write it this way: facts, issue, held, principle. But at third year level, really, all your lecturers expect from you is knowing the case, knowing the principle. That's all your lecturers expect from you. Then there's the last element of the gross income definition, and the element is capital and revenue. So receipts and accruals of a capital nature do not constitute gross income. So how do you then know if an amount is capital in nature, and how do you know if an amount is revenue in nature. So I'll give a quick example before I get into this tax case. If you buy a block of flats and you're renting it out and you decide to sell it after a couple of years, how do you know whether the proceeds from the block of flats will be gross income or capital in nature? The Income Tax Act does not really explain that in depth, and that's why we make reference to the case law principles. So this is a very important case in helping you establish what constitutes receipts and accruals of a revenue nature and what constitutes receipts and accruals of a capital nature. And the name of this case is CIR versus Visa. This was in 1937. All right. The facts. The taxpayer acquired mining options on certain farm properties. Unfortunately, the options lapsed before the taxpayer could even search for mineral deposits on the farm. The taxpayer then resorted to entering into an agreement with another person whereby the taxpayer agreed to assist the other person in obtaining the mining options in exchange for the shares in the person's company. So I'm going to read it again. The taxpayer acquired mining options on certain farm properties. And unfortunately, the options lapsed before the taxpayer could even search for mineral deposits on the farm. So this taxpayer then resorted to entering into an agreement with another person whereby the taxpayer agreed to assist the other person in obtaining mining options in exchange for shares in the person's company. So the court had to decide. In a nutshell, this person, let's just read the issue before I explain. So the issue was the court had to decide whether the shares that the taxpayer received were of a revenue or capital nature. So the court then concluded that the nature of the transaction and the taxpayer's intention when he entered into this transaction should be considered. And therefore, in this case, the principle that was introduced is called the tree and the fruit principle. Namely, that the tree is capital in nature and the fruit is revenue in nature. So in every transaction, you have to identify a tree and a fruit. So the tree will represent capital in nature. So proceeds from the tree will represent proceeds of a capital nature, and proceeds from the fruit will represent proceeds of a revenue nature, and that will be included in gross income. So let me give another example where the CIR versus Visa case will be applied. I'm going to make reference to the block of flats again. If you have a block of flats that you bought and you've been renting out this block of flats, so when you decide to sell this block of flats, you have to identify the tree and you have to identify the fruit. What is the tree? The tree is the asset that produces the fruit. So in this case, the block of flats will represent the tree because it's producing a fruit, which is rental income. Therefore, when you sell this tree, the proceeds will be capital in nature, and the rental income represents the fruit, and therefore that will be included in gross income. That will be revenue in nature. Let me give another example. If you've got shares and you are getting dividends from these shares, and you decide to sell these shares, right? So what is the fruit and what is the tree? In this case, the shares will represent the tree because it's producing fruit, which is the dividend income, right? So when you decide to sell these shares at a later stage, they represent the tree, and therefore the proceeds from the sale of shares will be capital in nature, and the fruit, which is the dividend income, will be revenue in nature. So there will be instances where a taxpayer is holding the shares, and they're not, the intention of holding the shares is not to earn dividend, but to just make a quick buck, to just make a little bit of profit. So if this taxpayer is buying shares and if this taxpayer is buying shares only to make profit as soon as they increase in value, then that person is trading in shares. That person is a share dealer. And if you're holding shares with the intention to make profit, then you're not holding shares as a capital asset, but you are holding them as trading stock. And in that case, the proceeds from the shares will be trading stock, and trading stock is revenue in nature, and therefore the proceeds will be included in gross income. So this is a very important case. The principle from this case was very important. The tree and the fruit principle, very, very important principle that you will definitely be tested on. All right. Then there's the last case. I think this is the last case. Yes. There's the last tax case that explained the intention of a taxpayer. So we're still on capital and revenue, and this is the last element of the gross income definition. So this case was called the Natal Estates Limited versus SIR. So the taxpayer held a piece of land for many years as a capital asset. Before selling the land, town planners, consulting engineers, and professional advisors were approached to develop and subdivide the land. So this taxpayer has been holding a piece of land for a while now, and before selling it, he consulted town planners, engineers, and professional advisors to develop the land and to subdivide the land, right? So the issue was this subdivision a change of intention from capital to revenue? So that was the issue. Was subdividing the land indicating that the taxpayer has changed his intention when it comes to the land? Has he changed from holding the land as a capital asset or as a revenue in nature asset? Okay. So it was held that the original intention of the taxpayer to hold the asset as an investment is always an important factor, but that is not necessarily decisive. A change of intention evidenced by a manner or method of realization resulting in a scheme of profit making renders the profits of a revenue nature. The totality of the facts of the case must be considered. So the decision of the court was that the original intention of the taxpayer to hold the asset as an investment is important, but it's not necessarily decisive. So you have to consider all of the factors. A change of intention evidenced by the manner or method of realization, a change of intention evidenced by the manner in which this asset is being sold, result in a scheme for profit making renders the profit of a revenue nature. So if there's been a change of intention, it means this is an asset that was held as a capital asset, but the intention is no longer to hold it as a capital asset. The intention is to make profit from it. And therefore, that is, an indication of a change of intention of a taxpayer. So let's take a look at the principle. The principle from this case was that a taxpayer may realize his capital asset to his best advantage, yet must be careful not to cross the Rubicon and embark on a scheme of profit making. The onus is imposed on the taxpayer in terms of Section 102 of the Tax Administration Act to prove that an amount is of a capital nature. So the principle from this case was that just the mere fact that a taxpayer is selling an asset at a profit does not necessarily mean that they've now embarked on a scheme of profit making, right? So something more is required. Something more is required to prove that this taxpayer is now embarking on a scheme of profit making. This taxpayer is no longer intending to hold the asset as a capital asset. So the onus is imposed on the taxpayer in terms of Section 102 of the Tax Administration Act to prove that an amount is of a capital nature. All right. So these are the case law principles. There's a whole lot of cases, and you don't have to know all of the cases, but you need to know some cases that you'll be able to apply in discussion type questions and be able to link these cases to practical scenarios, to practical questions. So let's take a look at some of the objective factors that would be considered by a court. What would a court consider in deciding whether proceeds were of a revenue nature or of a capital nature? So I'm just going to go through them quickly. The courts will consider the nature of the taxpayers or the nature of the taxpayer's business or occupation, the frequency of similar transactions. So I'll give an example with shares. If this taxpayer is buying shares and selling so frequently, then that's indicating that the shares are held as trading stock. If the taxpayer is buying land and selling it so quickly, buying land to sell at a profit so quickly, that's indicating that the land is held as trading stock, and therefore the proceeds will be revenue in nature and not capital in nature. So that's what they mean by the frequency of similar transactions. The court will also consider continuity of activities, the length of time that the asset has been held. In the case of a company, the objective factors, in the case of a company, the objective factors of the directors, statutory documents, the minutes of meetings, activities of owner in relation to the asset during the time that the asset has been held, the documentary evidence, history of the taxpayer, the taxpayers holding the asset, circumstances of the realization, like how the asset was realized or how the asset was sold or disposed, accounting treatment of the transaction, the source of finance when the asset was acquired, involvement in a profit-making scheme, right? So these are just some of the factors that the court will consider in determining whether or not proceeds were capital or revenue in nature. So let's take a look at other specific transactions before we get into the special inclusions. So obviously this is a summary, and we can't cover everything in a summary, but I've just tried to summarize transactions that you come across a lot. So there's damages and compensation. A taxpayer can receive money in respect of damages or compensation. And I'll give an example of a case where a taxpayer can receive money for damages. So if a taxpayer, let me give a typical example. If a taxpayer sues someone, maybe like an employee or anyone, for reputational damage, right? So if this person has been bringing the company to disrepute and damaging the reputation of the company, then the company then sues this particular individual or company and receives money for damages and compensation. So yeah, that's an example of a case where a taxpayer can receive money in respect of damages. So how do you go about it? Does it constitute gross income? Does it constitute revenue? Does it constitute gross income or capital in nature? So how do you go about damages and compensation? So let's take a look at the first block over here. So if the damages were for loss or sterilization of a capital asset, then they are capital in nature. If the damages were for loss or sterilization of a capital asset, then the proceeds won't be capital in nature. But if the damages were for loss of profits, for loss of profits or loss of revenue, then the proceeds from the damages will be revenue in nature, because the intention is to fill a hole in the profit. So therefore, you need to look at what the damages were for, and the question will always be very clear what resulted in the taxpayer receiving the damages. So you need to read the question very carefully. Let's take a look at the debts and loans treatment. Repayment of debt or loan, that's capital in nature. But if the taxpayer is in the business of collecting debt, then that will be income in nature. Let's take a look at share transactions. So the Section 9C, and Section 9C of the Income Tax Act says that if a taxpayer has been holding shares for 3 years, then they become capital in nature, regardless of the fact that the taxpayer was a share dealer. If you're a share dealer, meaning that you are buying shares to make a profit, you're buying and selling shares to make a profit, you're a share dealer. But if you hold these, so if you're a share dealer, the proceeds will be revenue in nature. But if you hold these shares for a minimum of 3 years, then they automatically become a capital asset. So they move from being trading stock to a capital asset. And when you sell them, the proceeds will be capital in nature. Fortuitous gains, and examples of fortuitous gains are gifts and donations, inherited amounts, prizes. Fortuitous gains are normally capital in nature. So if a taxpayer receives a gift or inherits an amount or wins a prize somewhere, it's normally capital in nature. So the value will not be included in their gross income. Gambling and horse racing, sporadic successes, these are capital in nature. So if a taxpayer is a gambler or a horse racer, and he makes some money from horse racing or from gambling, those proceeds are capital in nature. But if the taxpayer is in the business of gambling or in the business of horse racing, if that's their line of business, then the proceeds will be revenue in nature. If the taxpayer wins the lottery, the proceeds will be capital in nature. Interest income. Interest income represents the fruit of the sum of capital employed as the tree. So this is the CIR versus Visa case. Interest income represents the fruit of the tree, and the tree is normally like a fixed deposit at a financial institution, at a bank or something like that, and that's the tree. And therefore, the interest income represents the fruit, and the fruit is revenue in nature. So let's take a look at special inclusions briefly. Like I've already mentioned, this is just a summary, but I hope it has covered almost everything. So let's take a look at the special inclusions. Paragraphs A to N of the definition of gross income include certain amounts in a taxpayer's gross income, even though they may be of a capital nature. These receipts and accruals are referred to as special inclusions. So special inclusions are capital in nature, and therefore they are included in gross income regardless of the fact that they are capital in nature. Remember, if an amount is capital in nature, it can't be included in gross income. However, these special inclusions are included in gross income regardless of the fact that they are capital in nature. So there's paragraph A up to paragraph N. Let's take a look at them briefly. I didn't include all of them. I've just included the ones that you will, most likely be tested on. So there's paragraph A, annuities, paragraph B, alimony, paragraph C, Services rendered, paragraph C, A, and CB, restraint of trade payment, paragraph D, lump sums from loss of office, paragraph E and EA, lump sums from retirement funds, paragraph F, commutation of contract of employment, paragraph G, leasehold improvements. Sorry, paragraph G is leasehold premiums. Paragraph GA is know-how receipts. Paragraph H, leasehold improvements. Paragraph I, cash equivalent of employment benefits. Paragraph K, dividends and foreign dividends. This is the paragraph that makes dividends and foreign dividends be included in gross income. Paragraph M, key man policies or key man insurance. Paragraph N, any other amount in terms of the Act. So please check them out in the Income Tax Act. So I've just explained a few of them. So let's take a look at annuities. Annuities, okay, let's take a look at the main characteristics of an annuity. Annuities are a fixed annual payment that is repetitive in nature, and it is chargeable against some person, you know, so there's an obligation to pay, and also does not reduce a capital sum. So these are characteristics of an annuity in terms of the ITC. ITC is an income tax case 761. So yeah, an annuity arises from the will of a deceased person, an inheritance or a donation, a pension or retirement annuity fund. So there's different types of annuities. You can inherit an annuity, you can receive it through a donation, you can receive it through a will of a deceased person. You can purchase an annuity. You can go to, you know, to an institution and purchase an annuity to say, I've got a lump sum, and with this lump sum, I want to receive a fixed amount of money, you know, for a certain number of years or for the rest of my life. So that's what an annuity is. This amount is included in gross income in terms of paragraph A of the gross income definition. But there's exemptions, which we are going to cover in the next session. Then this paragraph C for services rendered. And this is any amount, including voluntary amounts received by or accrued in respect of services rendered or to be rendered, in respect of or by virtue of any employment or holding of office. All right. So let's take a look at this case, CSARS versus Coutier, 2002. The taxpayer received a 200,000 reward from the police for information leading to the arrest and conviction of persons involved in illicit diamond buying. So this taxpayer received 200,000 Rand for giving the police information. And this person was not an employee of the police, but he rendered a service to the police, and therefore the High Court concluded that there was an adequate link between the service rendered and the payment of the reward. So the principle from this case is that the employer or employee relationship between concerned parties does not have to exist for the gross income definition to apply. So when it comes to services rendered, it's not necessary. It's not necessary to have an employer or employee relationship. You can render services to literally anyone, and that amount would constitute gross income in terms of paragraph C of the gross income definition. Then there's restraint of trade payment, and I've just shared paragraph CB. This is a payment received or accrued by a natural person in respect of or by virtue of employment or holding of office, or past or future employment, holding of office. Restraint of trade payments are capital in nature, but are included in gross income in terms of paragraph CA and paragraph CB of the gross income definition. Let me give a typical example of a restraint of trade payment for those who may not know what a restraint of trade payment is. Let's just say you're working in a bakery and you decide to quit your job, and your boss, decides to pay you a lump sum so that you don't, so that you don't go and open the same bakery, or you don't go and render services to a competitor, in another bakery, using the secrets of this, this bakery that you're working in. So that's just a typical example of a restraint of trade payment. So you are restrained from trading as a baker in that particular scenario. So that's what a restraint of trade payment is, and it is capital in nature, but included in gross income. Then there's lease premiums in terms of paragraph G of the gross income definition. And in CIR versus Butcher Bros, Pty Ltd, these were the characteristics that they came to when it comes to leasehold premiums. So a leasehold premium is any consideration having an ascertainable money value, passing from a lessee to a lessor in cash or otherwise. And this is the last point is the most important one. The most important one. Distinct from and in addition to or in lieu of rent. So lease premium is not rental income. It is distinct from and in addition to or in lieu of rent. So that's very important, because sometimes it's very, if the question doesn't tell you that this is a lease premium, it gets very tricky to sort of understand whether this is rental income or if it's a lease premium. So it's, this amount is distinct from and in addition to or in lieu of rent. So the treatment of a lease premium is it will be included in gross income of the lessor, which is the recipient. And this is in terms of paragraph G of the gross income definition. Then there's leasehold improvements. These are included in the gross income of the lessor in terms of paragraph H. Improvements made in respect of a lease agreement for the use or occupation of land and buildings. So the amount stipulated in the agreement will be included in the, in the gross income of the lessor. And very important, there must be an obligation to effect improvements in terms of the agreement. So I'll give an example. If there's a lessee and a lessor, they have to agree, there must be an obligation imposed on the lessee to say, can you please make improvements to this land or to this building? If you're going to occupy my building, please improve this and that. So the value of those improvements, that's what we call the leasehold improvements. The value will then be included in the gross income of the lessor. But if there is no obligation to effect these improvements, then the amount won't be included in the gross income of the lessor. So your question will always tell you whether there was an obligation or not. So you have to read your question very carefully and obviously be able to apply these principles. So there will be a relief for the lessor in terms of section 11H, which we will cover when we do general deductions and special deductions. So we have come to the end of our session, but let's take a look at this example quickly. Timmy Thomas inherited money in 2012. He bought 2 residential duplex units of 450,000 each with his inheritance. So he bought 2 residential duplex units worth 450,000 each with his inheritance. He has since received rental income of 10,000 per month, which he has declared to SARS. He is immigrating to Australia and he decided to sell these units. So the units were sold at 500,000 each to the tenants during the 2021 year of assessment. So if these units were sold for 500,000 each, that means he has received 1 million from the sale of these residential duplex units. So you're required to discuss with reference to case law, whether the 1 million rand that he received for the 2 duplexes should be included in his gross income or not. So that's your question for today. Please just drop your answer in the comment section. Let me know what you think. Will the 1 million rand constitute gross income, or will it constitute capital in nature? Thank you so much for watching. If you have learned something new, please do me a favor and give this video a thumbs up. And if you haven't already subscribed, please do me a favor and subscribe to my channel. Thank you so much, guys. Goodbye.